obviously we can't trade on fundamentals right now. And so this fall is going to be all about virus updates and vaccine updates. The economics is probably not going to matter. But if the market starts to believe that consumers are going to be very short as far as coming back, then the market is probably overpriced and we'll see a bigger decline.
What exactly perhaps either worries you the most about what you saw yesterday? Was it this notion that the leadership of this market is now showing signs of weakness and it could take everything else down? I guess how scared should we be? Or is this a situation where this is maybe just a normal run-of-the-mill pullback in an otherwise bull market?
Well, it's really interesting as far as the currents on this is concerned, because as you probably know, September has historically been the worst month over the last 70 years in the market. But what is even more interesting is that it tends to get worse as the month goes on. So the end of the month tends to be worse. So if this is not just a 1 or 2 day pullback, and it may be just a pullback in front of the numbers later this morning and a long weekend, but if it's really the beginning of something bigger, then we could see 15–20% pullback.
The market moves we saw yesterday did something, at least a little bit, to alleviate the valuation pressures that many have been harping about for weeks, if not months at this point, that technology stocks, communication services stocks, certain key ones are very extended in terms of their price to earnings ratios, a lot of other metrics. Has yesterday's pullback given you enough comfort to think that maybe some of these stocks are now value-ish relative to where they've been?
Well, it was still a small pullback when you look at the full range of the increase in the market since the end of March. And so yesterday's movement is not enough. Our view is that it's really two stock markets, and that there's a technology communication services market where the earnings visibility going forward is probably pretty good. And then there's the rest of the market. And so market participants, to the extent that they have diversified portfolios, need to think of each part of this market differently and thus invest differently. But yesterday was not enough to say that it's even good valuations in the technology range. It's just a matter of how extended can it goes. And if we remember 1999, it could become very extended before it ends.
All right, so there are some folks who are making some allusions to what happened back in the dot-com boom and perhaps even the great financial crisis. However, things are slightly different these days in many ways. But with all of those things in mind, Chuck, what is your investment thesis then right now? What exactly do you buy and what do you stay away from, given that kind of notion that you've just spoken about right now?
Well, at iSectors, our view is that investors should try to minimize downside risk in order to be able to stay in the market and last for long periods of time. And our view, even going into this pandemic and the recession, is that investors are under-diversified and that they probably have way too much in stocks. So, of course, that's been great for the last 10 or 11 years. You've done well by doing that. But investors really have to look at the diversification and probably should be adding bonds and even commodities, especially precious metals like gold in here, in order to have proper diversification. Within the equity markets, again, we think it's two markets. We think you've got to continue to be in the technology sector because, again, that's where we're going to see earnings visibility. But there are also sectors like utilities that are actually down for the year still, but are likely to be able to pay good dividends and will receive demand if we have this market decline we're talking about.